a little yes in the message box. I'm not sure I'm seeing anything.
You
Sounds
sound
good. Yeah, they're
great,
seeing you.
Ed.
They are okay. Very good. Just wanted to make sure. All right. Well, welcome everyone. Thanks for joining us here today. This is Ed Madla, the Director of Retail Education at the Options Industry Council, formerly a floor trader, pit trader in Chicago and New York, and then trading electronically for a number of years. I was a broker for a while in the futures industry, now just strictly teaching and educating the investing public about the listed options markets, both the benefits and risks. We don't give advice at the OIC, we don't give direction, we just provide straightforward education on the product. Today, we're going to talk about strategies for a bull and bear market. Rather simple, nothing too complex. Here's our disclaimer first. We'll have some calculations and examples today that will not include the cost of commissions, fees, or margin. Those are important costs in a live account, but we won't include those today. And for those of you unfamiliar with OIC who are joining us for the first time, we offer free education on our website, optionseducation.org, a variety of different formats of presentation, specifically the webinar program that we do every month. You can sign up for those sessions. The next one coming up will be selling puts on margin in the middle of September, and then I'm doing a 3-hour presentation at the end of September. It's going to include some of the material that I go through today, actually. So a lot of material on the website, and utilize the free services of the investor services team. Send an email to them at options@theocc.com, and they will answer your questions to the best of their ability. Today's just going to be walking through strategies. Going to go through a number of them. I don't want to call it rapid fire because we'll take it from the very basic level, simple level, and start to add complexity throughout. Most of the presentation is constructed for the basic level learner, but I'll throw in commentary as usual along the way to make it interesting, starting with calls and puts, and then adding to the verticals, and then getting even further into the level of complexity with the three-way spread. So adding complexity as we go. Let's jump into it first. On the simple side with buying options. So we're talking bullish and bearish strategies. The most simple place you can start are the outright trades. Super simple to understand as compared to buying long stock and owning shares. If you own shares at 60, you make money above 60, you lose below 60, and you can hold those shares as long as you want. If you're buying a call option, you pay a premium up front, and you need to retrieve or recover that premium before you profit. So in the example we have here, buying the 60 strike for $3 at expiration, the stock would have had to move higher by $3, or in this case 5%, before we reached our break-even point. Then we can start to profit. That's a significant cost to incur, increasing the break-even point by that amount. However, our upfront cost is a lot less. Instead of $6,000 on 100 shares, we're paying $300, and that's our maximum loss should we go wrong. That's the reason to buy calls versus stock: the lower capital requirement out front and the similar risk profile once the stock starts to move. It's not easy to make money buying options, and I'm going to say that right up front. There's a time and a place for it, but to be profitable on a trade like this, and you'll see call buying incorporated in some of the more complex strategies that we'll get to later on, you have to be correct on your market direction outlook and the magnitude of that outlook and the timing of when that's going to happen. It's not easy to line up those three pieces and be correct, and that may lead you to believe that these option buying strategies would be reserved for the situations where you have more confidence. At your more high confidence levels, you might be looking to buy options to profit. If you are correct and you buy options, works out in your favor, the percentage returns can be extraordinary, and they can work out really well for you, but difficult to do. It's hard to have a high batting percentage when you're buying options and trying to make money. And you also have to understand the effects that outside forces have on the pricing. And when we get through calls and then next puts, I'll discuss volatility. Certainly earnings plays a huge role in how options are priced with the possibility of future movements of the stock. And I'll use a few examples of investors that I've either spoken to or worked with our investor services team as they retrieve and receive questions from investors. Just yesterday, Tuesday, they heard from an investor who bought audio restored. Okay, we're all good now. Talked to the investor services team. They heard from a guy yesterday who had purchased call options on Monday as an earnings play. Stock was trading around $33 a share. After earnings were announced Tuesday morning before the bell, stock opened up over 5% higher, and the call options were slightly negative. He was slightly in the red on his call options, and of course furious. What happened? How is this possible? Well, certainly we know when an earnings announcement is released, there is a vol crush, implied volatility gets crushed, and the magnitude of that volatility crush is going to offset any gains you might experience from delta or the movement of the stock higher. And it's an important concept to grasp. The stock moving 5% higher had a positive influence on his call option. However, the vol crush, which was enormous, more than offset that positive influence, and it left him in a negative position. I took a quick peek at this stock. It was trading $35, but the 52-week high low was around 49 to 23. It was huge, so it wasn't too big of a surprise that the options were pricing in that large a move. And another quick look back at previous earnings dates, and I had seen this underlying move 10, 12, 15% after previous earnings announcements. So 5% was kind of a non-event for this underlying, and this call buyer who saw what he thought was a nice pop in the stock actually was sitting on a loss. And it's important to understand that it's not just about the stock moving higher. You also have to pay attention to upcoming events, the earnings calendar, and any potential for vol drops to work against you. So this is going long a call option, buying a call for a bullish trade. You might think, well, wouldn't the opposite, selling a call, be the bearish trade? And while that's true, I'm not going to get into that today, and I'm not going to emphasize selling call options. You know, we'll have protected sales of call options later on, but selling an outright call option is the most risky options trade anyone can do. If it's not protected, you have theoretically a limitless potential loss. That's something that can be managed from one day to the next. But if you're holding a position overnight or over the weekend, there is, from an educational perspective, no limit on how much you can lose. So selling an outright naked option is not really looked at as a bearish play. The risk reward there doesn't turn out to be favorable enough to consider that a bearish strategy. So call buying for the bull side, obviously this makes sense that we're going to flip over to the put side to be bearish. And I have a few things to say about here. First, the example, buying the 35 strike put. This is in comparison to shorting stock. Well, many of you may not ever short shares of stock and may not want to. Some of you might, but for many of the investing public, they're not shorting stock. In an effort to capitalize on a move lower, put buying is one choice they have. Similar to calls, you're paying premium up front. And in this case, we're buying the 35 strike. We're paying $225 for it. So we would need the move to not only be lower, but be lower enough by a magnitude of enough of a share price, and in the time horizon that we expect in order to be profitable. Again, difficult, but can be done, and you can see nice returns on a trade like this if you've got all of those pieces lined up. I'll give you an example here of one that didn't work out. I don't mean to scare anybody, but it's easier to remember the ones that didn't work out to try and avoid problems or surprises. And this goes back, I've used this example before. This goes back to last year. Stock was trading around 100, and an investor had bought the 80 strike put option, so 20% out of the money. A few weeks go by, an earnings announcement gets released, and the stock gets hammered by about 15%. It was trading $85. The option still had a few weeks to go, and this investor was virtually at break even. They were very, very slightly positive on the trade, and the stock was crushed 15%. So again, the investor was confused. What happened here, and why did I not see a greater gain? Well, taking a quick look at it, I could first of all see that it wasn't wide bid-ask spreads that were getting marked not in his favor. There was trading. There was decent amount of volume, so the market wasn't taking anything from him. The market was trading where it was supposed to be trading, buyers and sellers at the right price. So what happened? I felt comfortable enough saying, well, first of all, as I said with the call buying, you had an earnings announcement. Anytime you have that, you get an overall volatility crush, and that's going to have a negative effect on your option price. But in this case, you also had something else going on. There is volatility skew where the lower priced strike prices have a higher implied volatility, and that implied volatility starts to come down. And if you were plotting this on a graph, it would start on the left at the highest level and it would start to come down all the way to the at the money level, and just above that you would see where the implied volatilities bottom out. So you have this curve that slopes down, forgetting about the upside, just looking at the money and to the downside puts, you have a fairly steep slope. And with highly volatile stocks that have a tremendous amount of risk, that slope can be very steep. Now think that through. When he bought the option, it was 20% out of the money. Compared to the at the money level, it was very low, so at a very high implied volatility level on the curve itself. After a 15% move lower, his option now was about, maybe 5-6% out of the money, and had slid up the curve all the way from 20% out of the money to now say 5% out of the money. It sat on a very different place on the curve, much closer to at the money. So if you followed that, not only did you have an earnings announcement which dropped the entire curve lower, but you also had this slide along the curve that was very steep. So the option now sat at a different place. Both of those effects really had a negative impact on the long put position that this investor had. So understanding those things is important, and how volatility changes can impact the prices of options is important. There certainly is money to be made buying options. We'll walk through some other examples as well, but having an understanding of volatility and the direction, timing, and magnitude all locked in and feeling comfortable with where you're at is when you would want to take these positions on. On the flip side here, covering the last outright position, selling a put option. Usually it's done cash secured, doesn't have to be done that way, but usually it is. It could be considered a bullish strategy. If you are bullish but very cautious and very conservative, and you're not concerned about the stock moving much higher, then maybe selling put could fit the category of bullish, but I don't have it here as an example because that would be extremely cautious and very mildly bullish. Cash secured puts you might use in a more neutral environment, or if you were looking to purchase shares and weren't comfortable with the current stock level, selling puts out of the money is very popular there. So focused on the two buying sides, buying calls, buying puts, touched on the sell sides a little bit. Now let's take it to the next level and walk through adding one piece. We did the outrights. Now let's do the verticals, which are going to be, again, both bullish, bearish. We'll start with the bullish side and then make some pricing comparisons and risk profile comparisons between these strategies as we walk through. First, we'll do the bullish outlook side. So bull call spread, stocks at 90, got a month to go till expiration. A bull call spread involves buying a lower strike call, in this case 90, and selling the higher strike call, in this case 95. We do that for a cost of $1.35. Now the best thing that can happen here is the stock rallies through 95. We own the right to purchase shares at 90. We are obligated to sell shares at 95. We can capture that $5 difference, and that's the best that we can get. So if we can capture that $5 and we paid $1.35 up front for it, you can see the maximum gain potential here is $365. The maximum risk is what we paid up front. these options can only go to 0, can't get any worse than that, so risk 135. Margin in these cases for verticals really is the capital requirement that you're required to have up front. It's very straightforward. In this case, $1.35, we just have to pay for what we bought. And break even, the stock price at expiration that would pay us back the upfront cost. So if the 90 call option that we own is in the money by $1.35 at expiration, then we have reached our break-even level. Let's look at a profit and loss graph on this and then break it down a little bit. You see above 95, we reach our maximum gain and it levels off up there. We're obligated to sell the shares that we own the right to buy, and we can't make any more money up top. Down below $90, the options expire worthless, and we realize our max loss of $1.35. And in between, our profit and loss depends on where the stock sits in relation to 91.35. If it's in between the strikes, we have a decision to make. If we're at expiration and the stock's sitting around 91, 92, we have to decide, do we exit the position, sell the 90 call for what we can, and take a realized profit or loss off of that, or do we change our minds and buy the shares? With the stock in between strikes, we'll see this again in the further examples I walk through. When the stock is in between strikes, you are exposed to a potential stock position. And there's a difference in mindset for most investors, depending on whether or not that resulting stock position would be long shares or short them. A drastic difference between those two. In this case, the potential to buy shares might be something you'd be interested in considering. If not, remember, we were bullish and we didn't want to buy shares to begin with. If not, close the trade out and move on to the next trade. One more thing to mention, this is strike selection on the short side. Generally speaking, and this strategy is one of the examples, you're selecting a strike that you believe the stock will not rally through too far. So in this case, we're not concerned about giving up profits at 96, 98, or 100 because we don't think the stock's going that high. So to reduce our cost and reduce our risk, we sell the 95 strike because we're not too concerned about giving up those gains up above that level. In addition to that, the analysis is going to incorporate what can I actually get for the 95 strike, in this case 70 cents. That's a reasonable amount of premium. It lowers our cost by a notable amount, but if the 95 call was only trading for 25 cents, you might just decide it's not worth it to sell an option for that amount of money for the obligation that it provides or forces upon me. It's not worth selling an option for that price and getting the slight reduction in cost. So if that's the case, then maybe you're back to looking at buying a call, or if you're intent on doing a spread, you may shift your strikes around a little bit. You may have to lower the 95 strike and look at selling a 93 or a 94 strike. Changes your potential for gain, but lowers your cost at a magnitude that you're more comfortable with. So it's a little bit on strike selection and the bull call spread, buying the lower strike call and selling the higher strike call. Remember that, buying low strike, selling high strike. And we're going to see that again here with the bull put spread. So the second vertical that is bullish, two sides to the trade. We're selling a 115 put for $2 and buying a 110 put for 70 cents. The net credit here is $1.30. Now we're receiving premium. This is a credit spread, so the maximum gain is just going to be what we receive up front. The value of these options can't go any lower than 0, so $130 is our potential gain. Worst case situation is if the stock sells off and goes down under 110, we're obligated to buy shares at 115. We own the right to sell those shares out at 110. That would be a $5 loss, or giving back $5 to the market. We received $1.30 up front, and that's where 370 comes from. That would be a net loss of 370, giving back 5 after having received $1.30 up front. Margin requirement, capital requirement is the maximum risk. Could be higher, but that's right where it should be. And break even is when the higher strike that we sold is in the money by the exact amount of premium we received up front, $1.30. that means we'd be purchasing shares at $115, and we would now see shares sitting at 113.70. That's a $1.30 loss, and that would equate what we received up front. On the P&L graph, we'll walk through this and then make some interesting comparisons. Above 115, that's our sweet spot. Everything expires worthless, and we keep our max profit. Under 110, max loss, and in between the two, our break-even point of 113.70. Now on this side, and we'll contrast this when we walk through the credit spread on the call side, if the stock is in between the strikes, remember what I said earlier, when it's in between the strikes and the potential resulting position is long stock, it's very different from an investor's perspective than the resulting position being short stock. And in this case, we might decide that owning shares at 113 and with a break-even point of 113.70 is reasonable. So with the stock in between those two strikes, the 110 isn't worth anything to us, but we might go ahead and change our perspective. Maybe we're more bullish now that the stock has drifted down to that level and we're comfortable buying shares. So you want to keep that in mind as you manage the position. I do want to compare these two, the bull call spread that we bought and the bull put spread that we sold. So I'm going to toggle back. First of all, look at the shape of the graph here, how we have a flat line up top. The numbers are going to be different on the scale, but we flat line up top, and down below we flat line our loss, and in between we have this profit and loss depending on where the stock sits in between the two. If I go back to the call spread, it looks exactly the same. At the high strike that we, in this case, we sold, here is the flat line profit. At the lower strike, which we bought, you have a flat line, and in between you have profit and loss. We bought the low strike and sold the higher strike. And here the same thing. We bought the lower strike and sold the higher strike. So these trades are the same thing. Buying a call spread and selling a put spread has the same risk profile, and it works the same way from a risk perspective. It's interesting to understand and to notice that relationship between options, and I'll tack on some different numbers just to emphasize that. If you're looking at a 5-point wide call spread, let's say it's 75 strike and 80 strike, and you can buy that call spread for $3. Think about what that means. You're risking $3 if the stock drops. And if the stock rallies and you can achieve your full value of $5 from it, you make $2. So you pay $3 and you risk $3 to make $2 if the stock stays above the strikes. Think about what the put spread might be. Same strike, 75, 80. If we can sell that put spread for $2 and the stock stays above both strikes, they expire worthless and we make $2. And if the stock drops below the lower strike, we give back $5 of full value and we lose $3. So we risk $3 to make $2. It's the same risk profile between the two trades, and they are synthetics of each other. The differences are in the potential for variances in execution prices and what may happen with respect to position management, needing to close out the trade or having exercise and assignment activity. Most of the trading that you'll see will occur in the out of the money options, because usually the lower priced options that have lower deltas have more high quality, or I should say tighter, bid-ask spread. So execution prices on the lower priced options tend to be a bit better, so you'll see those trade more frequently. But it is interesting to note the similarities between the two. If anyone ever said they were interested in buying an in-the-money call spread for $3, the first thing that would come to my mind is, why wouldn't you sell the put spread? What price can you get the put spread for and sell it? Because that might be a better execution price. Also, if the stock stayed higher, you wouldn't have to deal with any exercise or assignment activity by selling a put spread versus buying a call spread. Just interesting comparison between the two. And those are the verticals on the put side. So let's look at the bear side. Same similarities, but I'll make some different comparisons here. Bear call spread, selling 5 of the 50 calls and buying 5 of the 52 half calls. We're doing this for a net total credit of $500, and that's selling 5 of them. That's $1 credit times 100 times 5. maximum risk here, the spread could have a full value of $2.50. We sold it for $1. So that would be a $1.50 loss on 5 contracts times the multiplier, $750 loss. We'd expect that to be the capital requirement. And break even, selling this call spread for $1 is when the option we sold, in this case the 50 calls, is $1 in the money, or we'll have to give up the $1 we received in premium up front. That would be at expiration at a stock price of 51. Now let's take a look at the P&L graph. And the P&L graph is here. So similar to before, if both the shares finish below 50, we have our maximum gain, maximum profit of $1. If the shares are above 52.50, the full value of the spread has been realized, and we give back to the market the full $2.50 minus the credit received up front. Max loss is $1.50, and then with the stock in between, in this case, probably going to have to do some position management, because if we do nothing and the stock is in between these strikes at expiration, will likely be assigned on the 50 call, and we will be stuck with short shares that we may not want to have. If the stock's at 51, the 52.5 call is worth nothing to us. Now, what if the stock is higher or close to 52.5? We may have to take action. It's a good time to describe the default process known as exercise by exception. For those of you not familiar with this, it's very useful to know that every option holder owns the right to exercise their option at their discretion, regardless of the moneyness of the option itself. Moneyness being, is it in the money or out of the money? Doesn't matter. The option holder can do whatever they want with it for whatever reason they want. But if the holder doesn't communicate any instructions to their brokerage firm, the industry then has to go to a default process, which is called exercise by exception. The strike price will be compared to the last traded price on a national exchange during regular trading hours to determine the moneyness of the option. If it's in the money, based on that analysis by at least a penny, the option gets exercised. And if it's not in the money by a penny, then it's abandoned. And that happens, we could say, automatically, if the option holder doesn't communicate any instructions to their brokerage firm. It's important to point that out in situations where you have the stock right around your strike at 50 or at 52.5. You want to be sure you know exactly what's going to happen. If the stock is at a few pennies above or below the strike you sold, you might not be sure if you're going to get assigned at all. And in order to avoid that, the only thing you can do is buy the option back. Same thing if it's sitting right around 52.5. You wouldn't want to have the stock trading 52.5 and then a few pennies higher than that, and then check the market after hours and see that it gets crushed or it goes lower, and you don't want to deal with exercising your option. But without communicating your brokerage firm, it gets exercised anyway. So it's always a good idea to proactively communicate instructions. When you're on the short side, you're not in that position. You have to decide whether or not you're going to be assigned and then take the appropriate actions. Be aware of that dynamic of how exercise works, specifically when the option and the stock price are very close to each other. That's the bear call spread. Let's look at the put spread. That would be bearish. In this case, it's a debit spread, buying the 90.85 bear put spread for $1.70. The best situation, if the stock sells off dramatically, we own the 90 put. That gives us the right to sell shares at 90. We sold the 85 put, obligates us to buy them back there, so we can capture $5 full minus the premium we paid up front. Maximum gain is $3.30. This is a debit spread. We paid $1.70. The most we can lose is $1.70, and the break-even point is when we are paid back the $1.70 at expiration. If the 90 put that we own is $1.70 in the money, then we retrieve our upfront cost and break even. And here's how it looks on the graph. Maximum profit below 85 tails off, above 90 tails off as well, our loss, and then in between, profit and loss determined by where the stock price is. Now, again, what if the stock is at 85? We have to be very concerned about what's going to happen with assignment. If it's trading right there or within a few pennies, now we own the 90 put, we're going to exercise this, but if it's trading right at a level where we're not too sure about assignment, if we happen to be surprised and not get assigned, even if the option's a little in the money at expiration, you might not get assigned. That might leave you with a position that you don't want to have. So that would lead you more towards closing positions when there's some level of uncertainty. It's really not too difficult to do, but from an educational perspective, it's important that investors understand when to be uncertain. When do you need to know whether or not position management is required? Some investors that I speak to who are newer to options think that if the option is out of the money at expiration, even if it's by a nickel or a dime, then it won't be assigned. Or if it's in the money, that it absolutely will be assigned. And it's not true, as investors are likely tracking after hours activity and also utilizing the full 60 minutes or so after the bell that their brokerage firm gives them to make that exercise decision. The comparison I want to make here between the bear call and bear put is a little different, and it's risk reward. Notice on the bear put side, we have a maximum gain of 330, maximum risk of $1.70. That's almost 2-to-1 in our favor. We can make almost double of what we're putting up to risk. That's the bear put spread. If we look at the bear call spread, and I apologize, the numbers aren't as clean. I just wrote them differently to expand the calculation here, but just notice the comparison between the two. We're risking more than our potential gain. We flipped it the other way around. Certainly 2-to-1 risk reward looks a lot better than a situation of risking more than you can gain, but there's a reason for that. And it has to do with the probability of success. When you look at the bear call spread, let's say in this case, the stock's trading here right around $50 a share. If the stock does not move and it stays neutral, we reach our max gain of $1. If it drops at all, we also have a max gain. And in fact, our break-even point isn't until we rally 2% to the upside, 50 to 51. A 2% move against the direction that we thought the stock was going is where our break-even point is. That's a nice range of profitability, and that's why we have a risk reward breakdown that looks as it does, standing to lose potentially more than we could gain because of that advantage. Now, if you look at the bear put spread, say the stock's again right here at the strike at 90, in this case, if the stock is neutral, we have a max loss. In the previous case, it was a max gain. And if the stock rallies up here, we experience max loss, but we have some room we have to make up. And a $1.70 move, that's what we paid for the spread on a $90 stock. Again, that's just about 2%. That's coincidental, by the way, but about 2% move lower that we need in our favor to get break even. So not, flip from the other side. We could have experienced a 2% move in the opposite direction by doing the credit spread and reach break even. On the debit spread, we need a 2% move in the direction we expected. So that is why the risk reward looks different. It's a key difference between doing a debit spread and a credit spread. A lot of investors and traders I've spoken to over the years will have strategies that define what risk reward they're looking for. And some want 2-to-1, 3-to-1, 4-to-1, but really it comes down to how often are you successful. I'll certainly take a 1-to-1 risk reward ratio if I can be successful 7 or 8 times out of 10. If I'm only successful 5 times out of 10, but I'm getting 3-to-1 or 4-to-1, then I'm looking much better. So it does depend on your success rate, what risk reward you're looking for, but note that the credit spread will not have a risk reward in your favor. The credit spread will, I should say, also have a much higher likelihood of probability of success. The debit spread, a risk reward that looks a whole lot better, but the likelihood of success is not as attractive. And that's the vertical. So we covered the outrights, buys, calls, and puts. We did the verticals, the two-sided spreads. So now let's add another piece. and look at the three ways. First, the bullish side. We've done our analysis, we've looked at the market, and we think stock's going higher. We've covered these different choices of things you can do. You can buy the shares if you're really aggressive and you want to go all in on buying the shares. You can do that. You can buy calls. You can buy bull call spread. We covered that. We can sell a bull put spread. All these different things you can do. Let's turn this into a three-way and actually combine both of them, the call purchased and the bull put spread. And let's walk through what that looks like and why we would do it. Here's our example. The three sides, buying 4 of the 110 calls, and we're just picking prices off of here and getting execution prices that are close to the values we retrieved on our calculator. So buying 4 of the 110 calls for 430, selling 4 of the 100 puts, and buying 4 of the 80 puts, and doing that spread for a $4.80 credit. That leaves us with a net credit of 50 cents to do this whole three-way. Now, A and B is gonna compare. The driving force behind the trade is we're bullish, and we want the upside potential to gain with big moves to the upside. Significant moves higher, we want to capitalize on it. Buying calls is the comparison trade, and paying $17.20 to buy 4 of the 110 calls, or do the three-way and receive an upfront credit of $200. You can probably see right away we've done a very important thing here. We've taken away the theta risk entirely. When you buy an option and the stock's not moving your way, or it starts to trickle in your direction, or maybe trickle the other way, the painful part is seeing time decay working against you, and every day the option value losing money through time decay. We've eliminated that here, and that's a big benefit to doing a three-way. However, there's also a big cost to that. Whenever you compare option strategies, there's a benefit and there's a cost. So we'll look at that on the next slide when we put up the P&L graphs here. We have a comparison now. Buying 4 of the 110 calls for 430. That's one trade we might do, and we're going to look at that here. And the three-way is all done for a 50-cent credit, and that's going to be the right side. So we have our stock prices at expiration. If it sells off and goes in the other direction that we're expecting by a large amount, then this does not work out too well for the three-way. You can see how much more you're risking as a loss as compared to just buying the calls. You buy the calls, you're risking what you paid up front. When you do this three-way, you are virtually risking the difference or the spread between your put strikes. That's assuming your net cost is around 0. Your risk is going to be the difference here. In this case, it's significant. It's a 20-point difference. So we're risking 20 points. We did this for a $50 credit. So 19.5 points is what we're risking overall. And if you do the math there, 19.5 points times 100 times 4, that's $7,800. So a lot larger risk. That's the downside. And it's a much more significant capital requirement than buying calls outright. This is a significant negative for doing a three-way. What are the positives? They're significant as well. If the stock is right around here, 100, 105, 110, our calls expire worthless. We lose all of it. 1720 is decayed by the time we've reached expiration down to nothing. Whereas the three-way, we had this credit. If everything expires out of the money, if the stock is in at 105, and look at these strike prices, everything's out of the money, we just keep the credit received. We've taken that theta risk completely out of it. And if we're correct on our directional outlook, we've actually increased the profits. And I'm going to throw up the P&L graph in a second, but we've increased the profits here because we have more deltas. Not only did we buy a call option, that's long delta, we sold a put option and bought a lower strike put. So that is also long delta, the put spread side of things. We sold this spread and it enhanced our returns if the stock rallies. So those are the two benefits. Take theta out of the equation And if the stock rallies and it goes the way we expect it to do, we have enhanced gain because we actually combined two bullish strategies. We didn't say double up, but we added two strategies together. For those two significant benefits, we accept a much larger potential loss. It looks really interesting when you put it on a graph. And here is buying 4 of the 110 calls for $4.30. You see what that looks like. That break-even point on the upside is 114.30. And let's put up the three-way that we were able to do, again, for a 50-cent credit in this case. That puts our break-even point a whole heck of a lot lower than that. If the 100 put that we sold goes in the money by 50 cents, then we've given back the 50-cent credit. So that break-even point down there is at 99.5. That's far lower than buying the outright call is, and that's because we've taken the theta decay out of the equation. Now we do have a pretty big spread here, and you'll notice on the downside just how much of a difference the risk is. I did that by design. You certainly might look at a higher strike put or changing these strikes a bit. When you do that, to be more conservative, you're probably going to change this and flip it from a credit to a slight debit, but not take as much risk. 20 points wide, it'll be up to you. How confident are you in the trade? How far out are you going? Do you really think the potential for a massive move in the opposite direction that you're expecting is likely? How likely is it? And then choose the appropriate width in between the strikes. Looking at it here, we chose strikes that virtually did this three-way spread for break even, and you can clearly see the benefit. The break even point is so much lower than going long calls. On the upside, we always outperform the long call to the upside, and we get all of that exposure. The stock rallies 120, 130, 140. We have all this exposure to the upside to keep making money. We have a call option that can keep gaining value, and we didn't pay for it. We don't have theta risk. Two huge positives, and we accept this much, much greater potential loss. So it's an interesting way to combine a couple of strategies and be bullish. Same thing on the downside, so I'll walk through this a little bit more quickly. It's the same idea. We've talked about selling shares short when you're bearish, buying puts, buying a put spread, selling a call spread. They're all negative delta bearish trades. The three-way would take two of those and combine them for a different risk profile. Here, buying 4 of the 95 puts and then selling a call spread up top. Doing that for a net credit of 40 cents. Buying the outright puts costs us up front, and trading the three-way leaves a credit. So it's exactly the same analysis. I won't walk through the details because it looks the same. If the stock moves in the direction we expected it to move, our P&L here on buying puts profits nicely. Our risk is contained at 17.20. If the stock drops, we start making money, and we continue to make money on the downside. On the three-way, our risk is not nearly as contained as buying puts, but we've eliminated theta. And on the downside, if we're correct with our bearish outlook, we make money at the same rate as the long put because we own the same put, but the overall profit is enhanced because we've added to it a short call spread up top. So the three-way is going to keep outperforming, and the slope of the graph is going to be the same between the three-way and buying the 95 puts. It's different ways to put things together, and looking at it on the graph, same as we saw before, the break-even point is much, much different. The 95 puts for 430, that puts us at 90.70 is a break-even point, and up here, up above 105, selling that for a 40-cent credit, so 105.40. Just a huge difference in where the break-even points line up. With the stock somewhere in here, that can be very enticing to want to capture the downside potential that you think is going to happen and not have to worry about theta, and knowing that your break-even point at expiration is way up here. Be concerned and realize that you're giving up a much more conservative, controlled risk profile to get those other benefits that I mentioned. And that's the three-way bearish side. So we've covered a lot. Outright positions, then we added one piece to do the verticals, and then added another piece to do the three ways: one ways, two ways, and then three ways. The single leg trades, there certainly is, like I said, a time and a place to get that directional exposure with limited risk. Adding a vertical can control that risk, choosing your strike prices wisely, with your short strikes being a level where you think the stock might get to but not break through. That's generally how you're choosing your short strike prices. And then we added an element and got to the three-way, offering more potential profit, eliminating theta decay, having this sort of no money down concept. You know, you're likely going to have a small debit or maybe achieve a small credit depending on your strike price selection, but having the long option with directional potential and not having theta, that's the main benefit for doing the three-way while accepting much greater loss. That's walking through, I guess we could say, one ways, two ways, and three ways as a way to sum up what I went through. I'm going to put our contact information back up on the board. The investor services team, make note of that. Reach out to them at options@theocc.com. Check out our YouTube. Tons of past presentations on there. And again, our website, optionseducation.org, is where you can sign up, not just take education and do it in a self-study format, but sign up for our monthly webinar series that we have each and every month throughout the year. And I think I will turn it over to Maria to wrap it up.
Hey guys, so if you thank you, Ed, again for an amazing class. Send me your questions. Either type them in Discord or type them in the questions box. I think Teresa, if she is here, will be manning Discord.
I'm here.
Yay!
You've
J-Mac
got
had a
here, and I'll
question.
take Discord.
Perfect. So J-Mac had a question. Is there somewhere on the OIC site that shows you how to look at IV and calculate IV crush?
The best, there is. There's a historical and implied volatility tool on the OIC website. You have to, you go to the website, the menu can be expanded on the top left, and then you have to scroll down. You'll see calculators, quotes and calculators. One tool is called the historic and implied volatility calculator, where you can put a symbol in and you can track the actual volatility levels. And then also, if you wanted to not track them yourself historically to see crushes, the calculators can be helpful to forecast if an option's trading at a certain IV level and in next week after earnings you think it's going to be at a different IV level, and you can do that analysis by using options calculators, just changing the parameters of days to expiration and a new implied vol level and forecasting what you think the new option price will be, with some level of certainty and some level of uncertainty. But I think more directly, the answer to the question is we have a tool that will provide volatility levels, and you can input symbols. And if you had further questions when you get there and you're playing around with the tool, the investor services team is very in touch with that tool. They use all of the website material frequently. So if you have further questions, send them an email and they'll help you out.
Jason wants to know, for a three-way, can it work on a shorter time frame, say 2 weeks or 3 week expiration, or is it more of a long-term options play?
It's a really good question because I didn't address it too directly. If I were to speak more on my history of using three ways, I was a little more longer term using them. I discussed one of the great benefits is taking theta out of the equation. So I was not looking too near term. If I was very bullish long term and I was willing to accept the more, I'd say, massive risk that I was dead wrong, I just gave the market more time to work in my favor, and I wasn't concerned about what theta might be doing. So I might be going out, for me, long term, 3, 4, maybe 6 months. Certainly any of these strategies can be used on any time frame, but generally speaking, I like the question because for me, the three-way trade has generally been one that looks out a bit longer. Don't worry about theta and give yourself plenty of time to let the stock move in your favor. Of course, your market outlook might be short term, And if that's the case, then you might sort of dial it back and do a monthly or something shorter than that. But by and large, for me, it's been longer term options for the three-way.
Perfect. John wants to know, how does IV crush or expansion affect the three-way?
Another good question. So if there is an IV crush on the three-way, you have to remember there's sort of a muted effect. You will likely have two long options and one short option. It kind of depends where they sit on the curve and what your strike price selection would be. If there's an overall curve crush, you would expect that the two long options would have a vega that are greater than the short option, and that would work against you. So all else equal, a general answer would that a crush would work against you. However, the effect is muted because you do have a short option in there, and depending on your strike selection, that effect could be greater or it could be more muted depending on where the strike sits specifically with those put strikes and versus at the money. Again, to be more direct, I would expect a vol crush to have a slightly negative effect as you're punching a trade up. Hopefully you're able to check out what is the vega of this position. Just add up the vegas, do the arithmetic on the three positions, see what the vega is. I would expect that it would be positive, and then you'll know that that a vol crush would have a negative effect.
Awesome. What other questions do you guys have? Teresa, do you have anything over on Discord?
I don't.
Okay. We'll give them a couple minutes or a minute or so and see if we get any more questions. That was really a great class, though.
Thank you, Ed. It was, as
you.
always, awesome.
That's good to hear because I put this together not too long ago, and I intend to use it moving forward at some various events. So that's good to hear that it went well. It was actually the first time I've done it. So I was kind of somewhat doing it on the fly, but I think I liked it too.
Yay! And getting lots of thank yous over on Discord. So thank you, thank you.
Good. Yeah, and if there's more questions, if people come up with questions later on, again, just jot down the investor services team or reach out to the good folks at BlackBox and they'll help you out.
And that's a great question. Wes has it. Is there any chance that you can email me the deck so I can share it?
Yes.
I know we have a few of them.
We do. And normally that's a no-brainer, and I would just say right away, this is the first time I'm doing this one, so I may need to get clearance to send this one out.
Just let me know.
Yeah.
I'll send you a follow-up email.
Yeah, go ahead and do that, and I think I'll just check on it real quick, and if I can't send it out immediately, then I'll just ask for approval to do it sooner. If not right away, then very soon I'll be able to get the deck and the slides out to you.
Yay, thank you, thank you.
Okay.
And I think that is all of the questions that we have. Everyone, at least on the webinar and in Discord, they're both saying, or both places, they're all saying, thank you very much, awesome class, great content.
Well, great. Thanks for being here. I enjoyed it, and always look forward to these events.
Question.
It's great working with the event. Yeah, we got one more.
Antonio says, or is asking, do you recommend the three-way when playing flow? More specifically, should one be more mindful of strike?
I didn't catch. Do I recommend the three-way? And what was the rest of that?
So when playing options flow.
Flow?
Yeah, like the order flow. So he's talking about options order flow.
Yeah.
More specifically, should one be more mindful of strike? I think that's probably more of the meat of the question is how mindful are you of the strikes you're playing in a three-way?
Well, this is my interpretation of the three-way. I always started with the zero cost entry, and I looked at what strikes worked out that way. Of course, you want to get the lowest strike on the call you can, and the highest strikes, well, not the highest necessarily, but the tightest strikes on the put side that you can do at zero cost. That's the emphasis is on taking theta away and not having a debit, or if you do have a debit, it's really small, so theta is not a concern. So I always start by looking there. If the stock's at 100, what call would I buy? And remember, the driving force is the bullish outlook. What call do I want to buy, and what does that cost me? Then I can take a look at the put side and see, well, if I sell this particular put, what put do I have to buy to get this at break even money? And then you start to analyze the trade that way. You know, sometimes I price these things up and I'm not comfortable. I have to sell too high strike of a put, or maybe the width is a little bit too wide. You know, the example I gave, it was 20 strikes wide. It's not uncommon to see that. So you do have to tolerate that wider risk, but sometimes it doesn't work out very well based on the prices. And of course, every stock has a different skew to it. So as you're looking through the strike price, especially with skews that are more steep, you're buying that lower strike, you may have to price this up, start with an even money analysis on all three options, and then just do your diligence and incorporate your confidence level, decide, do you want to tweak it one way or the other, move your strikes around, take on a little more risk. As I said before, when I would go out longer term with the three ways, it made me more comfortable with the risk that I was wrong. You know, if the trade was a significant potential loss, but that loss was really if I was, you know, not just wrong, but incredibly wrong. 6 months from now, if this stock that I think is going higher from today for the next year, if it's 20% lower, then that max loss comes into play. And you can't make light of it, but that provided some level of comfort to me to take that big potential loss and that maximum risk. The question on strike selection is really important because it's going to determine where you're profitable and whether or not you can get things done at even money. But I would at least start there. I never wanted to do those at a debit, and if the strike selection forced me into debits, I was inclined to maybe not take the trade. I wanted even money or credit.
Okay, another question. As for closing a three-way spread, does it make sense to close legs individually or all at once?
Depends where the stock is. If you are doing, say, a bullish three-way and the stock has rallied significantly in your favor, if you're a risk taker, you might just let the puts expire worthless and not do anything with them at all. That was the approach that I usually took if I was right about the trade and it went in my direction. I was only focused on when and how to get out of the calls. What price do I want to get? And assuming you have multiple positions, when do I start scaling out on the call side? And you can even do more options trades and make it more complex and start selling calls up above to bring in premium and obligate yourself to get rid of shares above that strike. So if you're looking on the upside, it's working in your favor, scaling out at the appropriate level and just focusing on the calls and letting the puts go away. Same thing if it's neutral, it's letting the puts go, letting the calls go and taking my even money trade and moving on. If it's starting to move against me, when you're managing a position and you're trying to exit, you're always reevaluating. Do I now not think this is going to be bullish? I thought something was going to happen and now it didn't happen. I've got this three-way on that has a significant amount of risk. Managing things as they're moving against you is a little bit different. The call options tend to disappear rather quickly if it's moving against you. You probably can't get much of anything for it. If you're selling your long call for very little, it's usually not worth it. Might as well just hold on to it, see if the stock turns around. But exiting the puts is something that's just comes down to managing risk. I guess what I'm saying is I in my experience, did not exit the three-way all in one piece almost ever. I was exiting either the calls or the put side without touching the other side.
Gus said thank you for that
Great.
answer. And I think we are out of time for today. Guys, thank you for joining us. Again, Ed, you're awesome. Thank you for teaching us and doing this presentation for us today.
Great.
And other than that, I'll let you wrap up and we're
Wonderful.
good to go.
Yeah, thanks for the invitation as always, and we'll see you guys next time. Have a good day.
Take care.
Thank
Good night.
you. Bye-bye.
Thanks. Bye-bye.